Hey, Troy. Um,
Hi.
Thinking about the cash flow statement, are you able to pull a profit loss statement that is only doing cash for a period of time? Does that also, are those two things similar, or is there an overlap within that?
Good question. And yes, yes. In the case of, and a lot of companies, especially if you're talking income tax, the IRS likes on a cash basis. So the one that pops into my head the most is a restaurant, in particular, maybe a fast food place. Um, this is where, the answer is yes and no, because here's why. When I go in and I eat, when I go out to eat, which will be really nice when we're able to do that again, but I go into Chili's and I order my meal. They fix my meal. I pay them when I leave. So from that perspective, their income is going to be predominantly cash. So they're probably not going to have much accounts receivable at all because it's all cash basis. So in that case, the cash flow would be affected the minute that I made the sale. The minute that I walk out the door, the cash flow is affected. Where it gets hairy is that the only time that cash doesn't affect the income, that operations doesn't affect the cash flow statement at all is if I also buy everything and pay for it with cash. So let me go on. I go in, I eat at Chili's, I'm the customer, I pay for it. So before I leave. So the income statement is going to be all cash. My cash in is going to equal my balance sheet. It's going to equal my income statement. Everything's going to be the same on the money coming into my business. But if I'm buying raw goods and I'm paying, they deliver it and then I pay them later, I'm still going to have an accounts payable to be paid. So my cash out is not going to be the same until I actually pay for it. So the answer to the equation here is if you pay for cash for everything and you only receive cash from your customers, your income statement and your cash flow will be really, really close to the exact same thing. So that's the caveat. Now, Keely, did you kind of follow that? Okay.
Yeah, yeah. Well, I'm thinking of a particular button on QuickBooks. When you're able to pull a profit loss statement, there's a cash
Mm-hmm.
button and there's an accrual button. And so the cash button is for everything that is already cleared, and then the accrual are the outstanding invoices. So I was trying to see how that relates to the
Yep.
cash flow statement.
So in the case of QuickBooks, QuickBooks actually, frankly, is terrible at cash flow statements. And so what they've done is they've said, if you want to see a cash flow statement theoretically over time, run your income statement on a cash basis, and then you can compare it to your accrual. And so that's kind of the purpose of that. But the other thing that's effective for in QuickBooks is income tax reporting, because income taxes, as you know, are until you pay for it. You don't get to take a tax deduction until you pay for it. And you don't have to claim income until you're paid for it, until you receive the actual cash. So QuickBooks has the ability to track this stuff on a cash basis for that purpose.
Okay, that's
Good
helpful.
question,
Thank
though.
you.
Yeah. So, okay. So the gaps in cash in versus cash out need to be covered by working capital. So let me go a little further. Here's an example of the cash flow statement. Now, I'm not going to go too deep into this because this gets so complicated. My message to you here is, if you really want to work with cash flow, the Indiana SBDC has some much better tools that you can use, and you can type in your income statement, your balance sheet over a few months, and it will run a cash flow statement for you and help you track that. So short of having your accountant do it for you, I'm going to present it here. I'm going to walk through it just for situational and knowledge, but there are much easier ways to do this than to sit down and try to do this by hand. But here we go. So this cash flow, it is the change in cash coming in and going out. And I've got change in all caps because that's what it is. It's the change from when you did it yesterday versus you did it today. So you start out with sales. In this case, it was $300,000. Now their accounts receivable, they added on the decrease in accounts receivable, because you usually look at a balance sheet when you do this. So you started out with $300,000. My accounts receivable reduced by $10,000, which means I got paid for $10,000 of my accounts receivable in total. So I got $10,000 more in cash. So that increased my cash collections, and I got 300. So I ended up with $310,000. Then you start subtracting things off, things like cost of goods sold, and then an increase in inventories or an increase in accounts payable. Now you'll see you're adding on an increase of inventories because you're actually subtracting here. So if your inventories go up, your cash goes down. So you're going to, whatever your inventory increased by, you're going to subtract that off your cash collections. And then if your accounts payable went up, that's a negative, and so you're actually going to end up adding that on. In this case, accounts payable went up. If accounts payable went down, you spent more cash, so you're going to subtract that off. So you kind of see how this thing gets tricky to understand. You got to think in your head. If I paid more payables, I spent cash, so I'm going to subtract that. But if I didn't pay accounts payable using the money I made in sales, then I actually have more cash, so I'm going to add that on. So you kind of see how this thing plays out, and it's tricky. But the point I'd like you to walk away with today is to understand that cash flow and income, they don't measure the same thing. Cash is looking strictly at cash. So again, if you're a cash-based business, then it's a lot easier because you're thinking, I pay for everything in cash anyway. When I pay for everything within 30 days. Well, then, your cash flow is going to be the same as your income because the money you're getting paid within 30 days and you're paying for everything within 30 days, then it's going to be the same. But that's rarely actually how it plays out, because most of the time you buy something, they send you a bill, and then you pay for it the next month. And so it kind of comes into play that way. But again, on this one, there are much easier ways to do this than filling it out by hand, and we can help you with that. Okay, you got a question?
Troy, we got a quick question. Yeah, so just a point of clarification. When you're talking about accounts payable, does a bank see that as a debt?
Yes, a bank sees that as something that has to be paid. Now, because it does have to be paid. So if your company were to go under, you're going to have to pay all those accounts payable because it's money owed. And a bank, normally, those have to be paid before a bank can take the profits at the end. And so they're going to look for that. That's why it's listed as a liability. And it's usually listed as accounts payable because a bank says, oh, okay, we get it. That's your accounts payable. That's something that's daily. It's viewed a little bit different from an actual loan, though, because accounts payable and accounts receivable are viewed as things that are normal as part of the doing business. And they understand that they want you to have some accounts receivable because that means you've got money coming in over a period of time. And they want you to have accounts payable because that indicates, wow, you're doing business. What they don't want to see is accounts receivable that you've carried, that you haven't been paid for in 60, 90, 120 days. In that regard, they'll ask you to do what's called a write down on it, which means that the longer that accounts receivable sits out there, the longer it goes and someone hasn't paid you, the likelihood they're going to pay you decreases. And the standard in the business world is once it hits 90 days, the chances you're going to get paid drop exponentially by the day after that. Likewise with accounts payable, the longer it takes you to pay your bills indicates the less able you are to pay your bills. So they want to see accounts payable and they want to see accounts receivable. They just want to see them both. They want to see those balances not being carried over a course of the time. Now what they'll ask you to do, they're called schedule of accounts payable and schedule of accounts receivable, meaning they'll ask you to give them a report that shows who owes you money and how long have they owed it by customer, and who do you owe and how long have you owed them by vendor. And so as long as everything's within the 30 to 60 day range, you're in pretty good shape. Now there's a ratio that we're going to talk about a little bit later that they'll run really quickly. And most of the time they're just looking at a ratio. And if you fall within the norm, they're okay with it, because you always are going to have people that don't pay you on time for whatever reason, and they understand that. And there's always times when you might have you might have to carry an accounts payable longer than 30 days. For example, if you disagree with what you owe. And so it's not like if you have one that's past 90 days, oh, you're done. Or if you have one that you haven't been able to pay within 90 days, oh, you're done. It's looking at the total picture. Okay, was that too much information on that, Jack, or did that help, or completely confuse it?
I think that was pretty good. Thank you.
I didn't see you waving your hands going, stop talking, stop talking, stop talking. So anyway,
No, I mean,
right,
you were on a roll, and yeah, everyone seems pretty happy with your answer. So
yeah, on a roll. Okay, that's a positive way to put that. So are we good? You want me to go on?
Keep going. Yeah.